Hi everyone, welcome back to the US CPA classes of FAR, yes, Financial Accounting and Reporting classes. In this particular video, I'll be walking you through the complete curriculum which you can expect of chapter 4 coming in your examination, that is your select transaction. And this particular topic is around 20 to 40%, 20 to 30% of your examination. So very important topic from the CPA exam perspective. So let's understand what all things you can expect in selected transaction chapter 4. Now it's a time to jump into the overview of chapter 4, which is selected transaction. So selected transaction, this is around like 20 to 30% of your exam. In that, we will be understanding about accounting changes and error correction. So accounting changes are of two type, or error correction is also of two type. So accounting changes, one is this change in gap, and you need to adopt new gap, like moving from ASC 605 to 606, moving from ASC 840 to 842, right? Moving from ASC 320 to 326, right? Those things were like the change in gap, and which require you to change the accounting policy or upgrade your accounting policy. Second is change in methods, right? So change in method, like we were discussing earlier, changing from FIFO to LIFO or FIFO to weighted average, right? Same way in the depreciation, earlier you might be using straight line, now you have switched to WDV method, so on and so forth, right? Whenever there is change in accounting principle or there is a change in accounting method, you need to consider the impact retrospectively. But if there is a change in estimation, then you need to consider the impact prospectively. What is change in estimation is about? Change in estimation, for example, you have heard about provision for doubtful debt. Have you heard about it? Provision for doubtful debt?
Yes, sir.
So what is provision for doubtful debt? So today on, let's say, 31st December, whatever is the debtors you have in your accounts, out of them, what you are expecting, you may not recover, right? So let's say previous year, your 1% of the receivable were not recoverable. That's what you have assumed. But looking at change on account of this COVID situation, on account of this big pandemic, like people have lost their job and businesses have gone down, right? And this year, you are expecting maybe 2% of your customer, which is sitting on your account receivable, may not make the payments, right? So now your provision has been changed from 1% of the receivable as a provision for doubtful debt to the 2%, right? This is change in estimate from 1% to 2%, and this need to be considered as impact prospectively, not retrospectively, right? So their impact you'll be considering in the current year financial statement, but not in the previous year financial statement, or not in the opening balances. Whereas when there is change in accounting method or accounting principle, you need to consider the impact in the previous year number or the opening balance of the previous year as well, right? Make sense? What is change in estimate and what is change in accounting principle or method? High level, you got some idea?
Yes, sir.
Yes, sir.
Kashish, Avneet,
Yes, sir.
got it? Okay, so in this, we'll be understanding what is change in accounting principle, we'll be understanding what is change in accounting estimate, and how to deal with the respective change into the accounting system. Then change in reporting entity. So change in reporting entity, for example, earlier your company was XYZ Limited. That has been acquired by ABC Limited. So now the reporting entity name has been changed to ABC, right? So how you need to treat that change in name or change in the reporting entity entirely, right? So let's say earlier you are an individual, right? And you were doing, like, say, a software development work, and you have a sole proprietorship, and you are doing you are developing softwares for third party. And now during last year, you have developed some software at your own and Google has acquired you, right? So earlier you might be following cash basis of accounting as an individual, but now you have merged into the Google. So now you need to follow the accounting principle which is being followed by the Google. How to consider the impact of such change, right? The last one is correction of error. For example, if there was an error in the previous year financial statement, how you can correct them in the current year, right? So those all things will be understanding in 4.1. Make sense? Then 4.2 will be understanding business combination. What are the form of business combination? That include your acquisition, your merger, your joint venture, your subsidiary, your holding, right? So all kind of combination that can result into a consolidation would be covered over here. Here we'll also understanding the method of acquisition, whether you are acquiring in an equity method or you are acquiring as a purchase, right? And if you are acquiring in an equity method, how to account for the goodwill, how to account for the discounts, how to account for the transaction assets and liability which is moving from another entity to your entity. And if you are doing acquisition by purchase of asset, then at what value those assets need to be accounted for, right? The next one is recognition of goodwill. When you are doing acquisition or merger or business combination through any mode, then there is high possibility that goodwill will arise. If you are paying, when goodwill will arise? When you pay more than the book value. When you are paying more than the book value, that means the amount which you are paying in excess of book value is for goodwill, right? So that goodwill will arise. How you need to account for that goodwill? How you need to consider the goodwill for the impairment at each period end. Those all things we'll be studying. And then last one is bargain purchase gain. Bargain purchase gain, if you are paying less than the book value, that means you have negotiated better and that is your gain. How to do the accounting of that gain and how to recognize that gain in your financial statement. So those all things we'll be studying in topic 4.2. 4.3 is contingency and commitment. You know what is contingency? Any idea what is contingency?
So we an uncertain event which could lead to a compensation or a loss to the company, like an outcome of a lawsuit. So it's
Yeah.
not yet finalized, but it is expected that it might raise some liability towards the company.
Yeah. Anyone else would like to add? Gurmihar? Kashish? Akash? Shant? Would you like to add something?
Contingencies can be of two types, right? Like gain contingency and loss contingencies. So like maybe if there is any lawsuit against the company and it is like probable, then we have to book the loss or expense immediately. And we are expecting any gain, but until we receive the money, then we don't book that. Like we follow like we are little conservative.
Conservative, yes.
Yes.
Absolutely true. Yeah, in contingency, so it can be both gain or loss, but generally when we discuss about contingency, we discuss majorly losses because contingency gains are not allowed to recognize in the financial statement until it is actually recovered, right? So that's the reason we focus more on contingency loss. Contingency losses are of possible future outflow or potential future outflow. There are 3 degrees basis which we need to consider the impact of contingency on the financial statement, which is probable, possible, and remote. If the contingency is probable, then you need to account for the loss and you need to book a journal entry for the estimated loss. If the contingency is possible but not probable, then you just need to give a notes to accounts, a disclosure of that. But if contingency is remote, then you have nothing to do about it in the financial statement, but you just be keeping in your accounting record to keep a track. So if the contingency is remote, then you have to do nothing in accounting, but you just need to keep on eye on how things will shape up finally. If it is possible, then you need to give a disclosure in the notes to accounts. And if it is a probable, then you need to account for and book the journal entry. We'll be discussing more in detail about litigations, claims, assessment that may result into the contingency. Second is commitment. Have you heard about this term before? Commitment. Any idea what is commitment?
So when the two parties are, agreed upon the agreement.
When two parties are agrees to what? To provide goods and services for the consideration.
Yes.
Right, that is called contract. What is commitment? And why it is important for accounting? Gurmehar, Akars.
Maybe like if company has committed a certain bonus for the vendor, like let's say if they meet the SLAs or something like that, or contractual obligations, and it is probable that they are going to meet, then maybe we have to book the commitments on our book.
Yeah, that's a good example. For example, let's say company do have a distribution channel, right? To the distribution channel, they give certain targets. On achievement of certain target, they provide some gift or they provide some compensation to them, right? So for that, there is a commitment to those distributor. If you achieve certain target, that as a company we will be providing you these benefits, right? Second is yes.
These obligations can be an example of commitment.
Yes, but those are more comes into the probable category and you need to account for. But commitment are like open purchase order. That means you have already issued a purchase order, but material has not received yet. That is your commitment that in future you will be receiving such and such material from him or her and you are paying certain amount for that material. That comes under the commitment. So this is also required, the disclosure in the financial statement, what all open commitments you have, right? Which include open purchase order or as well as the commitment to your vendors, customers, distribution channel. Those all things comes under the commitment. Make sense?
Yes, sir.
And then next one is guarantee. Have you heard about this term before? Guarantee? When you purchase any big product, let's say your car, refrigerator, something like that, do you receive any guarantee or warranty?
Warranty, mostly
Warranty.
Warranty, sir.
Okay. And for example, if you are taking any loan, but you do not have sufficient source of income, and your parent is also signing that loan agreement, would it be considered as guarantee or warranty?
Guarantee.
Guarantee, right? So that comes under the guarantee where you are supporting some other's obligation or someone else is supporting your obligation, right? It can be performance guarantee or it can be non-performance guarantee. So what we need to focus is only the performance guarantee. For example, you are a subsidiary company of a US based company, right? And you are not making much money and no bank or financial institution is ready to give you loan. But when your parent company, who is like big giant and have a strong financial statement, they give the support letter to the bank, like if the subsidiary fail to pay, then we will pay you the EMI and interest. Then bank provide the loan. That means that subsidiary is backed by the guarantee of the parent company, right? Makes sense? So for example, if you are running any startup, to the startup, no bank provide any loan. But if you want to take a loan and as an owner of that startup, you have a strong financial statement and financial position, so then you can give your guarantee to the banker to provide loan to the startup. That calls of guarantee, called guarantee, and you need to disclose such guarantee in the financial statement. Make sense? Yeah, Pulak, Ananya, Rachita. Good. Next is derivatives and hedge accounting. Have you heard about this term? Derivative and hedge?
Yes, sir.
What is derivative, hedge, or what is financial instrument?
So derivatives are basically those instruments which derive their value from underlying asset like futures, options, forwards. And hedge accounting is basically accounting for such transactions in which we hedge our or uh, our losses or any future obligation that may arise by entering into a transaction, so that it's basically equal set off with loss and profit on a particular transaction. That's I remember hedge accounting.
Yeah, very good, Akash. So just in a layman, what you have explained is absolutely right. So just in a layman language, for example, let's assume Kashish is taking a loan from a US bank. He has taken an external commercial borrowing, right? That is called external commercial borrowing. Kashish is starting his own business, and in India, no bank is providing him loan. So he went to the US and talked to a Bank of America, and Bank of America is ready to provide him $100,000 loan for a period of 5 years at the rate of interest of, let's say, 4%. Right? So now Kashish needs to make the monthly payment of EMI, which is principal and interest, to the bank as a repayment of the loan. Yes? No? Are you guys with me?
Yes, sir.
Yes, sir.
Yes, Kashish? Will you be paying back?
Yes, sir. देना ही पड़ेगा.
So now you have taken a loan in dollar. Let's say you have taken a loan of $100,000, right? And every month, let's say you have to make an installment of $2,000 for a period of 5 years, right? So every time when you are making a payment at month end, there is a fluctuation in dollar amount. Yes, no?
Yes, sir.
Right? So there is a fluctuation in dollar account as well as the interest payment, because that is also in dollar, right? So to mitigate the risk of changing dollar amount, you enter into a hedge transaction. And there you fix the price of dollar which you need to make the payment by buying the future options in advance. Right? So that is called hedging of transaction, hedging of your future risk or fluctuation risk. Right? It can be the, you can say, currency rate risk, it can be interest rate risk, or it can be loan swipe risk also. So anything kind of transaction, any category of transaction, if you want to prevent yourself from the riskier situation, you go for a hedging transaction to mitigate that risk, right? So that is called hedge. And now coming to the derivative, derivatives are financial instrument. In this case, this external commercial borrowing is a derivative. And in addition to that, if you have purchased future options, that is also be considered as a derivative, right? So here we'll be understanding more in detail about what is derivative and what all categories of derivatives, then what is hedge accounting, and what all categories of hedge you can do to prevent yourself into the risky situation. And then lastly, what all disclosures required for all such transaction in the financial statement. That comes under the disclosure point of view. Right? These all will be understanding in 4.4. Next is foreign currency transaction and translation. What is foreign currency transaction? You are purchasing something from outside country or selling something to outside country. It can be good or it can be services. That is called transaction, right? And from that transaction, there might be some payable or there might be some receivable possible, right? When you reach to the year end or closing of the financial statement timelines, if there is any receivable or if there is any payable in the foreign country, that you need to translate to the year end conversion rate. That is called translation, right? What is foreign currency transaction?
Any purchase or sale.
Any purchase, any sale, any borrowings, any loan, any advance, right? Those all comes under the transaction. And whatever is the balance lying at the year end or at the financial statement date, that balance you are converting with the closing exchange rate is called translation. Make sense?
Yes.
So here in 4.5, you will be understanding all kind of transaction and what all required translation. Then foreign currency transaction, foreign currency financial instrument, which we have discussed above, and hedge transaction also, how you need to translate those transactions. And lastly, translation of foreign currency financial statement. Translation of foreign currency financial statement. For example, you are a US citizen and you have a company in US. Let's say you are Jeff Bezos, right? Owning which company? Amazon, right? Am I right?
Yes, sir.
So now Amazon have their operation in India also. That is called Amazon India Limited.
Yes,
right?
sir.
Now Amazon US need to make a consolidated financial statement in US dollar. Then they need to convert the Indian financial statement into US dollar, right? That is called translation of foreign currency financial statement to the reporting currency financial statement. Make sense?
Yes, sir.
So that we will be covering in 4.5.5. Next topic we'll be understanding is the lease. So lease, there's a new accounting standard of lease came effective from 2020, which is called ASC 842. So there we'll be understanding accounting of lease and the guidance. What all lease are being considered as a finance lease? What all lease are being considered as an operating lease? How to treat the finance lease in the books of lessor? How to treat operating lease in the book of lessor? How to treat finance lease in the book of lessee? And how to treat finance lease in the book of operating lease in the book of lessee? All these categories will be understanding. Then the special categories, which is sale and leaseback transaction. Do you know what is sale and leaseback transaction? Any idea?
Yes, sir.
What is that?
So basically, what sometimes organizations do is when they have a machine, a machine which has a big value, they sell it to another party, and then they lease it back to a claim. I forgot the reason, but this is why it is. This is how it is done.
Yeah. No, very well. Any of you can guess why company do sale and leaseback transactions? What is the major reason of doing sale and leaseback transaction?
Is it to reduce their depreciation expense?
Actually, they wanted to do like they want to reduce the capex and increase the opex.
Yep. Yes. Very good point. So they want to have a working capital. You know, sometimes company do have big machinery, but they struggle to manage their working capital. So this is easy way to manage the working capital by selling that asset to third party and taking that asset back on a lease. So by selling, they will get cash inflow to manage their working capital, and then they need to pay the small amount as a lease rent. So major reason generally for the sale and leaseback transaction is the working capital management. Make sense?
Yes, sir.
Yes.
And then another topic is non-reciprocal transfer, which is like barter system. That also will be understanding. Then research and development cost, how to deal with research and development cost, when it can be capitalized and when it should be expense of, right? Then software course cost, if you're developing the software, when you can capitalize that cost or when you need to expense of that cost, right? Then subsequent event. Have you heard about this term before? Subsequent event?
Yes, sir.
As an auditor, this is really a pain in ass. Now, what is subsequent event? Anyone would like to explain?
Events happening after the balance sheet date, but before the financial statements are finalized.
Yeah, very good. Anyone else would like to add? Ananya, Pulak, Rachita, Vineet, would you like to add something? What Agar said? Are you guys here?
Yeah, no, sir, same. It's same thing, like events occurring between the date of financial statements and the date of auditor's report. Or if the facts were discovered after the date of auditor's report, like those things.
Yeah. So there are two type of events: subsequently discovered event, right? The event which were already existing on or before the balance sheet date, and subsequently occurred event. That event occurred from the close of the financial statement to the audit date, right? So how to take care of the accounting and disclosure part of such event, that will be understanding in the subsequent event topic. Then fair value measurement. So in the fair value measurement,
one question.
yes.
So one question here, sir. Subsequent events में कभी-कभी intentionally भी sir हमें करना पड़ता ना after the
ideally we no company should do any intentionally. If they are doing any intentionally, it will be considered as a fraud.
Okay.
If it is by mistake, then it's fine. If it is intentionally done misstatement or mistake, that is considered as a fraud.
Sir, then we will put it into notes to accounts ना कि ऐसा हो गया या मतलब कोई भी event नहीं.
Fraud, then it will be like you are mapping audit to accounting. So if you identified any fraud as an auditor, then you need to revamp your entire audit strategy and look at like from the various perspective. Because if it is a fraud, then there's a high risk of like other things will also be influenced by the management, or there would be management overriding of control, right? But here we'll be focusing only from the accounting side, right? In FAR, our focus is on the accounting side, how to account for the subsequent events, right?
Sure, got it.
So next one is fair value measurement. For the fair value measurement, there are many valuation techniques which we will be understanding, like market capitalization technique or times revenue technique, discounted cash flow technique, book value technique, earning methods, or maybe liquidation value technique. So we'll be understanding different kind of valuation technique to do the fair valuation based on the you can say based on the requirement or based on the situation. We need to apply different methods, right? If the company is going for a liquidation, right, if there is a going concern issue, then most probably we'll be issuing the liquidation method. Otherwise, normally if we are doing valuation, fair valuation for, let's say, acquisition or merger purpose, most of the time we use discounted cash flow method, right? And sometime when we do like valuation for investment perspective, or you can say valuation for investors, then we go with the market capitalization method. So different methods are being used for different purposes. So all these valuation technique for the fair valuation will be understanding, and then fair value option also will be understanding, and new thing which is credit loss. This is new ASC 326. Earlier it was ASC 320, but now it is ASC 326 implemented in financial year 2021. So that we'll be understanding in detail about credit loss method for the financial instrument measured at amortized cost, right? These all will be covering in 4.11. And the last topic in the fourth chapter is accounting for change in prices. So, like you might have seen some company like petroleum product manufacturer. Have you heard about like the company who make polyethylene, polypropylene, or maybe chemical products through the petroleum, right? If you see the petroleum price fluctuate every moment, right? How to do the account for, how to do the accounting in such a situation for raw material purchase, right? So those we will be understanding in the journal price level of accounting, current value of accounting, and supplementary disclosure required for such kind of accounting treatment, right? Makes sense? This is all we'll be covering in chapter number 4. So in chapter 4 is selected transaction. First, we understood high-level accounting change and error correction, business combination, contingency, commitment, derivative, hedge transaction, foreign currency transaction, translation, lease accounting, non-reciprocal transfer, research and development cost, software cost, subsequent event, fair value measurement, and accounting for change in prices.